Is a super crash coming? The signals pointing to a major 2025 to 2026 collapse. Picture this, it's the autumn of 1929. The air in New York is thick with the scent of money and invincibility. Newspapers proclaim a new era, a permanent plateau of prosperity built on the miracles of electricity, the radio and the automobile. Stock tickers clatter like frantic crickets, recording ever-climbing numbers. Then, in October, the floor vanishes. The ticker tapes can't keep up. The roaring 20s end not with a whimper, but with a cataclysm that wipes out generations of wealth, ushering in an epic of breadlines and despair. The market would ultimately plunge 89%. It would take a world war and a quarter of a century for it to claw its way back. Now, fast forward to 2008. The enemy is different, but the story is hauntingly familiar. This time, it's not stocks, but the very homes people live in. A pervasive belief that housing prices only go up fuels a frenzy of irresponsible lending. Complex financial instruments, built on a foundation of sand, spread the poison through the global bloodstream. When the foundation cracks, the entire structure groans. The system survives only through trillions of dollars in government bailouts and emergency life support from central banks. The market falls 57%, and while the recovery is faster, the scars run deep, shattered retirement dreams, a lost generation of workers, and a deep-seated public distrust in the institutions meant to protect them. But what if I told you that these two historic collapses were merely the dress rehearsals? That we are now standing at the precipice of an economic event so vast, so synchronized, that it will make 1929 and 2008 look like minor market corrections? This time it's different. Not because the rules of economics have been rewritten, but because they have been ignored on a scale never before attempted. We are not facing a single bubble like in 1929 with stocks or 2008 with housing. We are living inside a multi-layered, interconnected super bubble and everything bubble where stocks, bonds, and real estate have all been inflated to dizzying, unsustainable heights. And when everything is overvalued, there is nowhere to run, nowhere to hide. Let's begin with the most visible of these bubbles, the stock market. The engine of this boom, we are told, is a technological revolution as transformative as electricity or the internet artificial intelligence. The narrative is intoxicating. It promises a future of limitless productivity and profit. And at the center of this story stands 7 corporate titans: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. They are dubbed the Magnificent Seven, and their influence is not just dominant, it is historically unprecedented. These 7 companies alone constitute nearly a third of the entire value of the S&P 500. To understand how dangerous this is, imagine a theater where 7 people are holding up 30% of the ceiling. If just one of them stumbles, the entire structure shudders. This level of concentration hasn't been seen since the eve of the 1929 crash, when a handful of industrial giants like U.S. Steel and General Motors propped up the entire market. But the parallels run deeper than mere concentration. It's about valuation, the fundamental math of what you pay for $1 of a company's profit. Historically, the market average is a price-to-earnings ratio of 15 to 17 today. The S&P 500 trades at a PE of 28. This level of overvaluation has only been witnessed twice before in history, in 1929. And in 2000, right before the dot-com bubble vaporized 78% of the Nasdaq's value. Now look at Nvidia, the current poster child of the AI frenzy. Its valuation has become untethered from reality. With a PE ratio soaring above 65, investors are paying $65 for every single dollar of profit. Its total market value has eclipsed the entire German stock market, the 4th largest economy on Earth. This isn't investing. It is speculative mania. It's a 1999 internet hype rebranded for a new generation. They were right in the long run about the internet's impact, but catastrophically wrong about the short-term valuations. The same devastating miscalculation is happening now with AI. The warning signs are not hidden. They are flashing in bright red for those who care to look. corporate insiders, the CEOs and executives who know their companies better than anyone, are quietly exiting the building. Throughout 2024 and into 2025, they have been selling billions of dollars worth of their own company stock. Jeff Bezos liquidating over $13 billion of Amazon. Zuckerberg selling Meta shares, Nvidia executives cashing out at the peak. This is not a coincidence, it is a pattern. It is the same pattern we saw in 1929 and 2000. The people in the know are getting out while the getting is good, leaving the narrative for the retail investors who will be left holding the bag. And then there is Warren Buffett, the venerable oracle of Omaha. His actions speak louder than any market analyst's report. He is not buying, he is hoarding. Berkshire Hathaway's cash pile has swollen to a staggering $325 billion, the highest in the firm's history. He is effectively parking the equivalent of a large nation's GDP in boring treasury bills, waiting for what? His own favorite market indicator, which compares the total value of all stocks to the size of the economy, is screaming danger. At 185%, it is far into the red zone he once said signifies playing with fire. The stage is set. The actors are in place. The stock market, the supposed barometer of economic health, is built on a foundation of concentrated risk, speculative mania, and the quiet exodus of the very people who should be its biggest believers. But what happens next will change everything. Because the stock market is only the first, and perhaps the most obvious layer of this crisis. The true rot runs much deeper into the very bedrock of the American dream, the housing market. And the data shows this bubble isn't just a repeat of 2008. It's exponentially worse. The fault lines beneath our feet, we all remember 2008. The images are seared into our collective memory. Foreclosure signs, abandoned subdivisions, the palpable fear that the foundation of the global economy was crumbling. That crisis was born from a housing bubble where prices had soared to 35% above their long-term historical trend. It was a deviation so severe it nearly broke capitalism. Now fasten your seatbelt for this fact. Today in 2025, home prices are not 35% overvalued. They are approximately 50% above their long-term trend relative to income and rent. Let that number sink in. The current housing bubble is 43% larger than the one that triggered the Great Recession. Why don't more people see it? Because a bubble doesn't feel like a bubble when you're living inside it. After years of soaring prices, this new altitude feels like the normal atmospheric pressure. We've grown accustomed to the insanity. We rationalize it with phrases like, "They're not making more land," or "low inventory will keep prices high forever." These are the same seductive lies, whispered before every collapse. The mathematics, however, are cold and unforgivable. When the average home costs multiples of the average income, something has to give. Either incomes must skyrocket, which they aren't, or prices must fall. But residential real estate is only half the story. While homeowners cling to the hope of perpetual appreciation, a slow-motion catastrophe is unfolding in plain sight in the world of commercial real estate. Drive through the downtown core of any major American city, San Francisco, Chicago, Houston. Look up, you'll see the silent sentinels of the coming crash, shimmering office towers with dark, empty windows. The pandemic-induced shift to remote work wasn't a temporary blip, it was a permanent seismic shift. Office occupancy rates have flatlined. San Francisco has a 35% vacancy rate. Nationally, nearly half of all office space sits unused. These are not just empty rooms, they are financial time bombs. Here's the mechanism of the impending detonation. These gleaming towers were purchased or built using massive mortgages, taken out when interest rates were at rock bottom near 3%. But mortgages don't last forever. They typically come due in 5 to 10 years, requiring refinancing. Now those loans are maturing. And the new interest rates are not 3%. They are 7%, 8%, even 9%. The math is brutally simple. A building that was barely profitable with a 3% mortgage payment becomes a cash-incinerating liability with an 8% payment. The rental income no longer covers the debt. The owner faces a grim choice: pour in millions of personal cash to cover the shortfall, or simply hand the keys back to the bank. We are already seeing the smart money, giant firms like Brookfield and Blackstone strategically defaulting on major properties. They aren't sentimental, they're pragmatic. They're cutting their losses and walking away. And who holds the bag for these defaulted loans? The regional banking system? These banks are not the too-big-to-fail megabanks. They are the community pillars, the lenders who fuel local business. Their balance sheets are stuffed with commercial real estate loans that are about to be recognized as nearly worthless. When a bank is forced to acknowledge that a $100 million loan is now backed by a building worth only $40 million, that $60 million loss vaporizes its capital. And when a bank's capital disappears, the regulators step in, the bank fails. We got a terrifying preview of this in March 2023, with the sudden collapses of Silicon Valley Bank and Signature Bank. That was without a recession. That was while the economy was still ostensibly strong. When the real recession hits and defaults surge, dozens, perhaps hundreds, of these regional banks will be wiped out. This brings us to the third and most insidious layer of the everything bubble, the bond market. In every previous crisis, when stocks crashed, investors would flee to the safety of U.S. Treasury bonds. This flight to safety would push bond prices up and interest rates down, providing a cushion for the economy. Bonds were the life raft. In 2025, that life raft is full of holes. The U.S. government is drowning in debt. The national debt has ballooned to over $36 trillion, a staggering 125% of the entire country's annual economic output. To put that in perspective, the last time we saw this level of debt was at the end of World War II. But back then, America was the world's undisputed industrial powerhouse, its competitors in ruins. Today, we face fierce global competition, and the debt is not from defeating tyranny, but from decades of deficit spending and crisis response. The interest on this monstrous debt is no longer a line item. It is the dominant feature of the federal budget. We now spend over $1.2 trillion per year just on interest payments. That's more than we spend on national defense, more than we spend on Medicaid. It is the single largest expenditure of the U.S. government. When your interest payment is the size of the entire economy of Mexico, you are no longer a nation managing its finances. You are a junkie dependent on the next fix of borrowed money. This creates a catastrophic feedback loop, a financial doomsday machine. If the government needs to borrow more to cover its deficits, which it does perpetually, it must sell more bonds. But if there's a crisis and everyone is selling everything, who will buy all these bonds? To attract reluctant buyers, the government will have to offer higher interest rates. But higher interest rates mean even larger interest payments on the debt, which necessitates more borrowing, which pushes rates higher still. It's a vicious, self-annihilating cycle that can only end in one of two ways: a default on the debt, or the destruction of the currency's value through hyperinflation. So we have three simultaneous crises: an overvalued stock market ready to buckle under its own weight, a housing market more inflated than the one that broke the world in 2008, and a sovereign debt crisis that has neutered the traditional safe haven. This is the everything bubble. And this is where the video takes a shocking turn. Because understanding the bubble is one thing. Understanding why the tools used to fight past fires are now broken, and why our leaders are completely out of options, is the true heart of the nightmare. The playbook is empty, and the firefighters have run out of water. The exhausted firefighters and the empty playbook. In 2008, when the financial world was teetering on the abyss, the authorities had a playbook. It was extreme, it was controversial, but it existed. The Federal Reserve and the U.S. Treasury became the heroes of the hour, deploying financial shock and awe to stave off total collapse. But what few realized was that they weren't fixing the underlying problem. They were merely transferring it from the private sector to the public balance sheet and kicking the can down the road. That can has now reached the end of the road. Let's dissect the 2008 rescue mission and see why every single tool is now broken, used up, or politically impossible. Tool number 1. Slashing interest rates. In 2008, the Fed, under Ben Bernanke, had ample room to maneuver. Interest rates were at 5.25%. As the crisis unfolded, they executed a dramatic rescue cut, taking rates all the way to zero. This made borrowing cheap, encouraged spending, and helped slowly resuscitate the economy. It was a powerful, conventional weapon. Today, that weapon is a pop gun. Rates are already low by historical standards. Even if the Fed cuts them to zero again, the impact would be muted. Why? Because the problem in the coming crisis won't be that credit is expensive. It will be that lenders are too terrified to lend and borrowers are too insolvent to borrow. You can lead a horse to water, but you can't make it drink when it's drowning in debt. Furthermore, cutting rates aggressively would be like throwing gasoline on a smoldering inflation fire. The public just lived through the worst inflation in 40 years. The Fed's credibility, already thin, would be utterly destroyed if they triggered another round. Tool number 2, quantitative easing, Kia, the money printer. This was the Fed's break glass in case of emergency tool in 2008. The Fed created trillions of dollars out of thin air and used them to buy government bonds and toxic mortgage debt. This flooded the system with liquidity and propped up asset prices. It was a Hail Mary pass, and it worked in the short term. But the Fed has already thrown that pass over and over again. After 2008, during the COVID crisis, and in various forms since, they have run the printing presses until they glowed red hot. The Fed's balance sheet, the tally of all these purchases, ballooned from under $1 trillion to over $7 trillion. The consequence? We just lived it. The inflation of 2021 to 2023 was the direct result of this monetary arson. The entire world now understands that QE is not a magic trick. It is a stealth tax on everyone who holds dollars, eroding their purchasing power. If the Fed tries to print on a similar scale in 2025, the market's reaction won't be relief. It will be a panic-driven flight from the US dollar itself. Tool number 3, government bailouts. In 2008, the political will existed, however painfully, to pass the $700 billion Troubled Asset Relief Program, TARP. The government went deep into debt to save the banks under the logic that the alternative total systemic collapse was worse. And it worked, in a sense. The system survived. But in 2025, the government's credit card is maxed out. With a national debt of $36 trillion and trillion-dollar deficits as far as the eye can see, where does another $2 or $3 trillion for a bailout come from? If the government tries to borrow that much, that fast, the bond market will revolt. Interest rates would spike into the double digits, crashing the economy faster than any bailout could save it. The political will is also gone. A populace still resentful of the 2008 bailouts and more polarized than ever would not stand for another massive transfer of wealth to Wall Street. The bailout option is functionally extinct. So let's be perfectly clear. The Fed is trapped in a trilemma. They can print money and destroy the currency via hyperinflation, let the system collapse and trigger a deflationary depression with 25% unemployment, do a little of both and guarantee a brutal period of stagflation, the worst of all worlds, with soaring prices and a contracting economy. There's no escape from this box. The firefighters have no water, and the fire is already lit. This exhaustion of policy tools is happening against a far more dangerous global backdrop. In 2008, China was a hungry, growing economic dynamo, ready to unleash a massive stimulus package that soaked up global exports and helped pull the world out of recession. Today, China is facing its own apocalyptic property crisis, a demographic time bomb, and a mountain of local government debt. Europe is stagnant, grappling with an energy crisis and political fragmentation. There are no healthy engines left in the global train to pull the rest of us to safety. When this crisis hits, it will be every nation for itself. The trigger could be anything. An earnings miss from one of the Magnificent Seven, a geopolitical flashpoint in the Taiwan Strait that disrupts tech supply chains, the failure of a major regional bank that everyone thought was safe. It doesn't matter what spark ignites the blaze. What matters is that the entire forest is drenched in gasoline. Most people never hear the next part, and that's the real danger. Because once the dominoes start to fall, the sequence of events won't be a slow decline. It will be a cascade of failure, a financial avalanche moving at digital speed. wiping out wealth in days that took a lifetime to build. The moment the first crack appears, the entire facade will shatter. The cascade, a scenario of collapse. It begins not with a bang, but with a whisper on a financial news ticker. Nvidia Q4 earnings miss, forward guidance week. The stock, trading at a PE of 65, has no margin for error. In after-hours trading, it drops 18%. The algorithms, which control over 80% of daily market volume, detect the anomaly. They don't feel fear or hope, they execute pre-programmed sell orders. The next morning, the contagion begins. The other members of the Magnificent Seven are sold in a sympathy crash. Microsoft, Apple, Amazon all down 8 to 12%. The S&P 500 plummets 5% at the open. This triggers the first wave of human panic, but the real accelerant is leverage. Across the country, retail investors who bought on margin using borrowed money receive the dreaded automated email, margin call. They must deposit more cash or their positions will be liquidated. Most can't, so their brokers automatically sell their stocks. This forced selling drives prices lower, which triggers more margin calls. The feedback loop is now active. Simultaneously, the institutional risk management systems kick in. A pension fund manager in Norway watches as her portfolio drops 15%. Her mandate requires her to sell a portion to de-risk. She clicks a button, and another $1 billion of selling pressure hits the market. It's not a decision. It's an algorithm. Within a week, the market is down 30%. The retirement accounts of 58% of American households are being eviscerated in real time. The panic now leaps from stocks to bonds. Frightened investors do what they've always done. They run for the safety of U.S. Treasuries. But this time, the safe haven is a trap. The flood of money into bonds should push rates down, but at that exact moment, the U.S. Treasury is on the market trying to auction off $100 billion in new debt to fund the government's operations. The market is overwhelmed with supply. The doomsday loop activates. To attract buyers, the government is forced to offer a higher yield. Interest rates spike. This is a catastrophic event. The government's interest payment, already over $1 trillion, now balloons even further. But the damage is more immediate. Every corporation and homeowner with a variable rate loan sees their payments skyrocket overnight. The corporate debt bubble, which has quintupled since 2008 to over $10 trillion, begins to burst. Companies that borrowed cheap money to buy back their own stock can no longer service their debt. They start to default. Now, the second wave hits, the banking crisis. The regional banks, laden with defaulted commercial real estate loans and holding government bonds that have crashed in value. Remember, when rates go up, existing bond prices go down. See their capital evaporate? A bank in Cleveland fails on a Friday. Over the weekend, news spreads. On Monday morning, a line forms outside a bank in Phoenix. It's a digital bank run. As depositors use banking apps to transfer their money to the perceived safety of JP Morgan or Bank of America, the FDIC steps in. They have $125 billion to insure over $10 trillion in deposits. The fund is exhausted by the third bank failure. To prevent total societal breakdown, the government announces an unlimited guarantee on all deposits. But how? They don't have the money. So, the Treasury and Fed coordinate to do the only thing they can. They turn on the printers. They monetize the debt. They create trillions of new digital dollars to make depositors whole. The immediate panic is soothed, but the fatal poison has been administered. The market now knows that the currency is being deliberately devalued. The dollar begins a freefall. Inflation, which had been tamed, comes roaring back with a vengeance. The price of bread, gasoline, and electricity starts climbing 5%, 10% per month. The real economy now seizes up. Layoffs, which had been tentative, become a flood. The tech companies that led the boom now lead the bust. Finance, retail, construction, the layoffs spread like a virus. Unemployment jumps from 4% to 8% in 3 months. Consumer spending, the engine of the American economy, falls off a cliff. The housing market, already frozen, goes into a deep freeze. Desperate sellers slash prices by 20%, then 30%. The new comps drag down the value of every home on the block. Millions of homeowners who bought at the peak find themselves with a mortgage larger than their home's value. They are trapped, chained to a depreciating asset. This is no longer a recession. It is a depression. The everything bubble has become the everything bust. Wealth vanishes not just from screens but from lives. Retirement is canceled, college funds are emptied, dreams are deferred indefinitely. The next part might completely change how you see this topic, because the aftermath of this collapse won't just be economic. It will reshape the social and political fabric of the nation for generations. The world that emerges on the other side will be unrecognizable, and the choices we make now will determine whether we are its victims or its survivors. The world on the other side. We stand at a unique and terrifying moment in financial history. The signals are not merely suggestive, they are overwhelming. The inverted yield curve, the historic market concentration, the largest housing bubble ever recorded, the insolvent banking system, the unpayable national debt, and the exhausted policy tools, they form a constellation of catastrophe pointing to a window between late 2025 and mid-2026. This is not doom-mongering, it is pattern recognition on a grand scale. We have seen this movie twice before, in 1929 and 2008, but this is the director's cut, with a bigger budget and more devastating special effects. The world that emerges from this super crash will be fundamentally different. The psychological impact will be profound. The trust in institutions, the government, the Federal Reserve, the banking system will be shattered, perhaps irreparably. The social contract will be strained to its breaking point as unemployment soars and social safety nets tear under the pressure. Politically, extreme economic pain breeds extreme political movements. The 1930s gave us the rise of fascism and communism. The coming years will likely see a surge in populism, nationalism, and social unrest as people look for someone to blame and for radical solutions. The center may not hold. For the individual, the landscape will be brutal. A generation of young people will enter a workforce with no jobs, setting back their lifetime earnings and life milestones, home ownership, marriage, children. Those near retirement will see their carefully built 401 KS turn into 201 KS, forcing them to work for a decade longer or face a destitute old age. Small businesses, the backbone of American communities, will be decimated, leaving an economy even more dominated by a few corporate giants. So, what can you do? Panic is not a strategy. Paralysis is a guarantee of failure. The time to prepare is now, while the storm is still on the horizon. This is not about becoming a survivalist. It is about becoming pragmatic. Deleverage, get out of debt, especially high-interest credit card debt. Reduce your mortgage if possible. Build a cash cushion, hold physical cash in a safe place. Bank holidays or digital transfer freezes are a real possibility in a crisis. Diversify safely. If you are invested, move away from overvalued speculative assets. Consider value, consumer staples, and perhaps precious metals as a hedge against currency devaluation. Develop resilience skills. What valuable skills do you have that would be needed in a recession? Focus on practical, essential services. Strengthen your community. The most valuable asset in any crisis is not gold, but a network of trustworthy people you can rely on. The coming storm is not certain, but the probability is higher than at any point in our lifetimes. The mathematics of debt and valuation are relentless. The warnings of history are screaming at us. This is the final act of an 80-year debt supercycle, and its conclusion will be violent and transformative. The question is no longer if a great reset is coming. The question is whether you will be blindsided by it, or whether you will see the horizon, batten down the hatches, and navigate through it to the other side. The choice for now is still yours. The crash is coming. The only question is whether you'll be prepared when it arrives.